Colliers International Global Business, and obviously across Europe, and therefore I'll spread it across Europe, I think. I think one of the points which was interesting in this morning's City AM was about London being attractive for startups, and I think it's the top European, well, it is the top European city for startups, and we touched on TMT earlier in Mark's presentation, the telecoms, media, technology companies. I think with younger people who are very dynamic and they want to sort of start up their own companies, I would definitely, not like Dragon's Den, but I would definitely back up buying real estate around the donut, if you like, around the core area. Core's too expensive, I think. So I would do a Colliers International startup fund going around the regional offices of Europe and regional cities, of Europe, and put office buildings around the centre. And then I'd have a mixture of flexible offices, a bit like service offices in a way, but slightly more subtle, a bit like Silicon Valley, where you actually back the people, the operators, the young people building up new businesses. That's what I would suggest. I'll stick to that.
Okay, good. Thank you. Andrew?
Well, I'd like to persuade you to put some of your money into global markets using funds, but I'm not allowed to do that. So
Quite.
So probably, well, we've touched on some of the themes already. So dominant regional city retail, well-located units or schemes within that. General long-income theme. I'd make you overweight in the Nordic region, which is more resilient than most, and second-tier German cities.
Great, thank you. Phil?
Obviously, a total conflict of interest for anyone IPD to start investing out there in the marketplace. But I mean, I think the one thing that we are seeing is across the funds that we're measuring, as I said before, an increased exposure to that alternative asset space. And that now is, in certain portfolios, as large as weightings in the South East office or the rest of the UK office market. I can only see that part of the market growing, and obviously to tap into the expertise, I'm certain that there'll be an emergence of new funds operating in that space as well. I mean, if you look at our pool fund indices, all the top performers for the last year have been residential funds, healthcare funds, hotel funds, student accommodation funds. So they appear to be the ones from a UK market perspective that are producing the stronger rates of return, whereas in London, prices are possibly kind of topping out and levelling off. But I'll leave it to everybody else to do the investment and just give us the properties and we'll analyse them.
Thank you. David?
Well, I'd stay clear of prime, probably look at some secondary property on the basis that it's sort of treated as a bucket and some of it is mispriced. Properties where there's an element of impairment which can't be treated as prime but could be managed to prime, or properties which have been effectively in suspended animation where people have not been able to put any capex in, the banks haven't wanted to, the borrowers can, but where putting in that extra capex will provide opportunities. I think, again, the alternative asset class is definitely an area in terms of creating product which you can sell on to the annuity funds. Is an interesting area in terms of long leases, but also short leases and index cash flows as well. Hotels, we find, is a very active area at the moment, and I believe there's good value to be had there in certain areas, and some hotels can be bought at a significant discount to replacement cost. And I think, for the risk-adjusted approach, debt origination on the right strategy still makes sense, and I believe there will be more new CMBS originations and B notes on newly originated CMBS with low values, and there's a new CMBS 2 regime will provide a healthy income return. So a number of variables, really.
Great, thank you. Finally, you, Peter, with your more value-added approach to my 500 million.
Really? Well, but I mean, the approach of attempting to finding property that is often coming out of distressed banking situations, which is management neglected and cash starved, where you can manufacture profit rather than waiting for the marketplace to do it for you, is certainly something that we are doing, we would do, that I think there will be increasing opportunities for that. But another area, because you helpfully did not put any risk profile or rate of return requirements on your 500 million, which is very graceful of you, because few investors would actually do that. But I think on the risk-adjusted basis, an area that I think is potentially of keen interest are prime or near prime buildings which are in a very awkward situation. For instance, they have lease terms that are 6, 7, 8 years long, because those are too long for the opportunists, so they won't want to buy them, and it's too short for the institutional owner, so they won't want to buy them. And people feel uncomfortable with the risk of, well, when you need to redevelop the building in 5 or 6 years or refurbish it, what's the marketplace going to be like? Who can possibly predict that? But based on my premise that we're in for a prolonged period of very flat economic growth and comparatively stable economic environment, albeit depressed, stable economic environment, I think those buildings the category of building presents an interesting opportunity, because you can buy them at comparatively high yields, take the income, and then in 6, 7, 8 years, there will be a redevelopment opportunity, and if they're fundamentally well located and the building fabric is fundamentally sound, I think those are very interesting opportunities. But there's very little money that's interested in that particular risk profile. But happily, I can take your money and do that.
Thank you very much for coming, and thank you very much to the panel. Thank you.